All right, we got to get to the elephant in the room. When you look at the Berkshire Hathaway shares, the B-class shares, if you look since May 2nd, when Warren Buffett said he was going to step down, they're down. They're down all over 9%, far underperforming the market. Does that mean that people don't want to trade like Warren Buffett or don't want to be like Warren Buffett, or do they just not have the same confidence in this particular company?
Look, you can argue it either way, but I would say it's completely divorced from the actual reality in the marketplace. If you look what happened since the tariff tantrum, since that date, we've been in a very narrow, momentum-driven market led by really mega cap tech. Value and quality tilted securities have been out of favor for the last 6 months or so. And it's all been about the Mag 7 Plus, right? So I think as the market switches back into a value-oriented market, that's when Berkshire does really well. And as we know, the market shifts, every cycle. So I think everyone should just hang on and realize that eventually value will be leading.
It's funny you say everybody should just hang on, because Berkshire Hathaway's hanging on to its cash, $381 billion, a new record. It seems like, and again, Warren Buffett's still leading the company, obviously, into the end of the year, but it seems like Berkshire Hathaway is kind of making a real clear departure from the rest of the market, because everybody else seems to see plenty to invest in. What does it say that their cash pile is hitting a record while everybody else is putting money not only in mega cap tech, but other parts of the market, speculative bets, this departure?
They're very disciplined. They have a very strong philosophy that, Greg Abel, who's been there for 20 years, has been steeped in the Warren Buffett philosophy as well, which is why I don't think there is going to be a very large departure in investment strategy when Greg Abel actually takes the reins full time. Look, they're very disciplined, right? They're not buying back shares because Buffett says, well, our valuation is not where I want it to be if I'm going to buy back shares. Let's hold on to our cash. Let's wait for the opportunities and then swoop in. And when we find something that we like, we're going to buy it in a big way. And that's what they've done historically, right? So, I mean, this cash hoard makes them I think just the cash hoard alone makes them a top 25 S&P 500 company, which is incredible if you think about it. So I think there'll be some buying at some point. It's just, when does the philosophy, when does their process dictate it needs to happen? And that's what we're waiting for.
A lot of people are going to talk about the fact that they're holding on to that money, not buying back the shares, but I also want to talk to you about some of the other moves that they're making, trimming some holdings like DaVita. What was your take on some of that action to actually trim some exposure?
Yeah, DaVita was more of a percentage of their portfolio, right? They specifically said they weren't opining on the operational soundness of the company. Rather, the position size was becoming too large, which was their trimming, and it's simple as that. So again, very disciplined. It's all about process and sticking to their plan.
All right, I want to ask you specifically about your ETF. By the way, your ETF, if we look back since May 2nd, it's only down about 1%. I know you have some options overlays in there and some other ways to make up or kind of mitigate a downfall. But one of the big tenets of Warren Buffett, and I'm paraphrasing, is he invests in businesses that he understands. However, we're in a market where there's a lot of businesses that I don't think a lot of people fully understand. I'm going to look ahead to Palantir after the bell, a very complex business that even the company itself, it has to send people to your company to make sure that your engineers and the people that handle some of your tech, that they understand what they do. Are we just seeing a market and an investor class that's moving away from some of the principles and thought leadership of Warren Buffett?
I think it always snaps back, right? I mean, having a disciplined process with a value-oriented tilt, it's been working for many, many years. So yes, I mean, mega cap tech has been taking the leadership for quite some time. Those companies their business models have become quite complicated. So I don't know that Berkshire is going to be dipping their toe into a company like Palantir, not opining whether it's a good company or not. It just doesn't seem to be in their wheelhouse. They like the railroads. They like the insurance companies, like financials. They like the consumer branded companies. And, those are going to be around forever. So my guess is they stick with what they've done over a long period of time.
All right. One last question for you, Adam. A couple analyst notes out saying that insurance underwriting may have likely peaked. The fact that we're in a freight recession, like some of these businesses, while they may be performing well right now, we could be seeing a peak right now. We're also going to be losing, hypothetically, the Buffett premium once he officially steps down. Does that concern you at all with a strategy that very closely mirrors Berkshire Hathaway, the fact that your ETF is so closely aligned to their strategy?
Well, our ETF, we hold Berkshire B plus the top 20 publicly traded holdings of Berkshire. So we're avoiding their Geico, all their private They're privates, they're railroad, they're insurance holdings. We don't hold those. It's all publicly traded holdings plus a 15% overlay. So 15% income annually paid monthly, 1.25%. So we've actually outperformed Berk B by 9% since inception of the ETF. Because of that
but
income.
Adam, in all fairness, I'm talking about your Berkshire holdings. I mean, when you buy the Berkshire stock, you're owning the other businesses. You're owning Geico. You're owning BNSF
Yes.
because you're owning a conglomerate.
Right. Well, we own a 10% stake in that. So we're not overweighted in Berkshire B. Apple is actually our largest holding, Berkshire B, American Express, Bank of America, those types of companies. So it's a well-diversified portfolio comprised of their top 20 holdings. So yeah, we do have Berkshire B in there, which I'm thrilled to have, again, because I think we're going back into a value-oriented market, and you're going to see Berkshire B act like a coiled spring and go right to the upside again once that occurs.